It's no secret that knowing how to start investing when you're a total beginner can be intimidating at first. The learning curve of the stock market, combined with the fact that you're putting your own money at risk, is often enough to scare many people away from what is actually one of the safest ways to financial freedom. That's why investing for beginners can be overwhelming. But it's important to remember that even the most successful investors had to start investing somewhere. And it's never too early to start planning for the future and learning how to invest. So congratulations! In this first video, I'll cover everything you need to know to set financial goals, start investing on your own, and make sure you're setting yourself up for success. And here's something I learned first when I was getting into investing that changed everything for me. The financial industry purposely uses confusing language and terms meant to scare the average investor away. The big fund managers have been able to dominate the market for a long time this way. So let's remember that they are the only ones who benefit from scaring the rest of us away. It's time more of us learn to play in their sandbox, so let's do this. Step 1. Pay off bad debt and avoid money traps in your 40s. Take a pause here and realize I just said bad debt. Bad debt means unnecessary debt, like the new car you didn't need or the upgraded phone you couldn't afford and put on a credit card. I'm not talking about your student loans or home mortgage. If you have bad debt from credit cards, then you want to pay those off before you start investing in the stock market. There is a good reason for this. Credit cards charge you interest. If you have an 18% interest rate on your credit card balance, then you'll be losing more money than you can earn from investments, even at 15% average returns. Pay that down first, so all the cash you can funnel into your investments is truly only making you money and growing your bank accounts. It's also worth mentioning that you should do your best to avoid common money traps people fall into. A money trap is anything you're spending your hard-earned money on that you can't really afford or don't really need just to keep up with the Joneses. These are things that will take all your money so you have nothing left to invest. Spending money wisely is one of the most important steps you can take to put your personal finance in the best possible situation before you start investing. Step 2. Create an emergency fund. If you figured out how to spend your money wisely, you've probably figured out how to save it. An emergency fund is, you guessed it, part of your savings that you have set aside in case of an emergency. It's a good idea to put 3 to 6 months of your living expenses into your emergency fund. It can just be in a savings account. That way you're covered if something crazy or unexpected happens, like a pandemic. Emergencies might look like your car breaking down, getting unexpectedly laid off, or having an unforeseen medical expense. Or it can also come in handy in case of a recession. Even if you don't have to tap into your savings account, you'll have peace of mind knowing there is a cushion available if you need it. Step 3. Learn the investing basics. You wouldn't jump into a boxing ring without knowing the basics of sparring and self-defense, so you shouldn't jump into stock market investing without knowing the basics. Before you begin building wealth, it's important to understand the true goal of investing as well as the process you'll need to use to reach that goal. At the most basic level, investing is all about buying $10 worth of value for $5. When you're able to buy a company for less than its true value, your investment return will grow over time. This is the ultimate goal of investing. Step 4. Utilize investing resources for beginners. The most important thing you can do to become successful is to get an investing education. And online if you want to learn more about the stock market and how to succeed as an investor. These resources include things such as books, blogs, podcasts, apps, investing software, and more. And other great investors. Step 5. Create an investment plan. Before you put your money in the market, you need to have a clear plan of what you want to accomplish and how you are going to do it. This is where creating an investment plan comes in. The best investment plan is one that is customized to your lifestyle. So follow the steps below in order to set yourself up on the path to success. Evaluate your current financial standing to understand your risk tolerance. Determine your goals and how long it will take you to realistically achieve them. Figure out which types of investments and strategies are the best way to get you to where you want to be. Having a clear investment plan will give you a ton of clarity as you start investing. Step 6. Keep emotions in check. One of the biggest mistakes new investors make is letting their emotions guide their decisions. Don't get too excited when the market is up or too fearful when it's down. Stick to your investment plan and remain disciplined. Step 7. Establish your investment strategy. Investing is more than picking a few stocks and hoping for the best. If you're doing it right, there's a real strategy involved, and you don't need an investment advisor to do it. These investment strategies include impact investing. Investing in companies that have a measurable environmental or charitable impact. Growth investing. Investing in companies that exhibit signs of above-average growth. Income investing. Investing in securities that pay dividends. Small cap investing. Investing in small companies that are new and have the potential to grow quickly. Value investing. Investing in great companies when they are on sale for prices lower than they are worth. The rule number 1 investing strategy follows the principles of value investing. When you invest your money in this way, you can still buy growth companies, small cap companies, and impact companies, but you buy them when they are on sale. This is the only kind of investing that will give you the highest rates of return with the lowest amount of risk. When you buy wonderful high-value companies for half or even a quarter of their value, you can experience big returns. Step 8. Determine where to invest. Once you've determined your investment strategy, you'll want to choose what platform or service you'll use. For most investors, an online broker will be the best option because online brokers allow you to place trades for a relatively small fee, while still offering all of the resources and information you need to make wise investments. Step 9. Build a stock watch list. Ready to get real. You've educated yourself and made your investment strategy, so now it's time to start narrowing down your list of potential investments. If you decided stocks are the right type of investment for you, you're in the right place. A stock watch list is your own personal list of companies that you've researched and found to be worthy of your investment. Once you build your watch list, you watch and wait for those companies to go on sale. Step 10. Know when to buy your stocks. Succeeding in investing in individual stocks is all about choosing the right companies as well as the right time to invest in the stock market, but the right time won't last forever. Once a company on your watch list goes on sale, it's time to buy. At this point, all you need to do is place your money in the company and keep it there for the long term. If you made a wise investment, your money will grow in value for many years after you invest your money in the company. And there you have it, 10 important tips for investing beginners. We hope you found this video helpful and informative. Remember, investing is a journey, and it's important to start early, diversify your portfolio, and remain disciplined. Thanks for watching.